Are you planning to file for Social Security benefits in the next few years? If so, this video will help you understand how Social Security retirement benefits work and the different filing strategies available. Hi, I'm Mike Heatwall, founder and CEO of the Dalla Group, a wealth management firm dedicated to helping retirees. In this video, I will provide details on the various filing strategies available to single individuals, married couples, divorced individuals, and widows. These strategies often secure higher monthly Social Security benefits for life, compared to the standard filing options typically selected. Now, one important clarification. This video won't discuss Social Security disability benefits, as those rules are complex and beyond the scope of today's topic. Instead, we will focus on retirement benefits and how to optimize your filing strategy. So let's outline our agenda so you know what to expect. I will start by providing an overview of Social Security's outlook and explaining who is eligible to receive retirement benefits. Next, we will walk through how to assess your benefit statement and highlight key details to review. Once we've covered the basics, we will explore filing strategies and real-life scenarios to demonstrate their application. After that, we will discuss how pension benefits may impact your Social Security payments. We will also cover some lesser-known topics, including retroactive benefits and the withdrawal of benefits. Finally, we will wrap up with a discussion on earnings limits and how Social Security benefits are taxed. As you can see, we have a lot to cover, so let's get started. The Social Security Trustee's annual report provides the outlook for Social Security. The latest report suggests the system will deplete its trust fund by 2033. To balance the system, a 21% benefit cut might be necessary across the board. Balancing the system means that Social Security payroll taxes would need to cover the benefits being paid out, since there would be nothing left in the trust fund to bridge any gaps. Currently, the taxes collected aren't sufficient to cover the benefits, leading to withdrawals from the trust fund. The critical question is, what Congress will do to address this issue before the trust fund runs out. Will they implement changes to the system or provide additional funding? The answer remains uncertain, and we may not know until the last minute. Politically, a 21% benefit cut would be challenging to justify, especially for any sitting president, as it would be detrimental to their re-election chances. However, given the historical tendency to delay action, we might not see a solution until just before the trust fund is fully depleted. Whether they find additional funding, print money, or take other actions remains to be seen. This is an important factor when deciding when to file for Social Security. So, who is eligible for Social Security retirement benefits? The Social Security Administration defines 4 primary ways to qualify for retirement benefits. The first relates to your earnings, while the other 3 involve qualifying based on someone else's earnings. So, to qualify based on your earnings, you need 40 work credits. In today's terms, you must earn $1,810 a year to receive 1 work credit. If you earn 4 times that amount, $7,240, you will earn the maximum of 4 credits in a year. Earning 40 credits is equivalent to working and paying into the Social Security system for 10 years. Once you qualify, the next step is to calculate the benefit you will receive. Your benefit is determined by your highest 35 years of earnings. For example, if you have 40 years of work history, only your top 35 years will be used to calculate your benefit, ignoring the bottom 5. As long as you continue working and earning more each year than you did in your lowest earning years, your benefit will increase as it's recalculated annually. However, if you don't have 35 years of earnings, any missing years will be counted as zeros. For instance, if you've only paid into Social Security for 20 years, the calculation will include those 20 years plus 15 years of zeros. As you continue to work and replace those zeros with actual earnings, your benefits will increase accordingly. So how do you access your benefit statement, and what information should you review? You can access your benefit statement online at ssa.gov by clicking the Sign In button in the top right-hand corner. If you've never registered, you will need to do so. Once you've logged in, you will see your latest benefit statement. Now, your statement will provide estimated retirement benefits each year, from age 62 to age 70. In addition to the estimates, Social Security provides the earnings assumption used when calculating these benefit estimates. This can be found in the second paragraph of the retirement benefits section. For example, the statement might assume you will continue earning a specific amount each year until you reach full retirement age. If this assumption doesn't match your actual plans, such as if you plan to stop working earlier, it could affect your benefit estimates. Now, if the statement assumes you will earn $51,955 per year until retirement, but you plan to retire at 62 and not collect Social Security until age 67, the 5 years with no earnings could lower your benefit amount. If the earnings assumption does not match your plans, you can use the online Social Security calculators to input your plans and get a more accurate estimate. The online calculators can be found at ssa.gov/benefits/calculators. The benefit amounts listed on your statement are calculated based on this assumed income. The amounts for different ages, like age 62, full retirement age, and age 70, are then adjusted as a percentage of your full retirement age benefit. For every year you wait beyond full retirement age, you receive an 8% increase in your benefit. If you wait until age 70 to start collecting, for example, you will receive a 24% increase in your benefit due to delayed retirement credits. It's important to remember that Social Security benefits increase slightly each month you delay, so you don't have to wait until your birthday or the next calendar year to see an increase. The monthly increase after the full retirement age is 0.67% or 8% annually. Alternatively, if you file before full retirement age, your benefit will be reduced. The reduction is approximately 6% annually. Now, the other important piece of information on your benefit statement is your earnings record. Social Security used to include your full earnings record on your benefit statement, but now they've summarized it into decades, which makes it a bit more challenging to spot discrepancies. To review your earnings record, log in to ssa.gov and navigate to the home screen. Under the Eligibility and Earnings section, click Review Your Full Earnings Record Now. Pay close attention to the last 2 or 3 years to ensure they've been reported correctly. Watch for any discrepancies, especially years showing 0 earnings, when you know you worked and paid into the Social Security system. This is important because your Social Security benefits are based on your earnings, so catching and correcting errors early can help protect your future benefits. I recommend checking your earnings record every 2 to 3 years. Correcting mistakes is much easier when caught early. If you spot an error from a recent year, you can usually fix it with a tax return. But if the mistake dates back to, say, 1999, tracking down the necessary documentation could be far more challenging. Now, let's explore Social Security filing strategies. We will start with strategies for single individuals. I have a simple break-even chart to help you understand your options. We will look at 3 filing ages, 62, 66, and 70. For example, if you file at 62 and collect $1,500 monthly, you will receive $18,000 yearly. By the time you reach 66, you will have collected $72,000 in total. But if you wait until 66 to file and start collecting $2,000 a month instead, you've left that $72,000 on the table. Now, we need to calculate how long it will take to make up $72,000 with your increased monthly benefit. In this case, the difference between $2,000 and $1,500 is $500 a month, or $6,000 a year. Divide the $72,000 by $6,000, and you get 12 years. So from age 66 to 78, you're just making back the money you didn't collect earlier. It's only after age 78 that you start coming out ahead. Similarly, if you wait until age 70 to file, it will take until age 82 before you start coming out ahead. I've kept this chart simple, skipping over factors like the time value of money, inflation, and potential returns if you invested the money instead. These elements could influence your decision, but the goal here is to give you a straightforward way to think about how long it takes to break even. These break-even figures do not apply to married, divorced, or widowed individuals, as these instances involve survivor benefits, which will be covered later. It's important to note that any time you file for Social Security benefits, whether they are retirement benefits, survivor benefits, divorce benefits, or spousal benefits, you need to be aware of the earnings limit. In 2025, that limit is $23,400. If you earn more than that while collecting benefits before full retirement age, your Social Security payments could be reduced. I will explain this in more detail later, but keep it in mind when considering your filing strategy. So let's move on to filing strategies for married couples. There are two main options: filing for your benefits or filing for spousal benefits. It's important to note that you will only be allowed to collect your benefit or your spousal benefit, whichever is higher. You cannot receive a benefit from your work record and simultaneously receive a benefit from your spouse's record. To illustrate, let's use Tom and Mary as an example. Tom is 66, and his benefit is $2,500 a month. Mary is 3 years younger, so she's 63 and plans to file at her full retirement age to receive $1,200 a month. The difference between their benefits could be due to Tom having worked 35 years while Mary did not, or perhaps Mary earned significantly less than Tom during her career, resulting in a lower benefit. So here's what happens. Tom receives $2,500 a month. When Mary files at 66, Social Security will assess her situation and determine she's eligible for $1,200 per month based on her work record. However, she's also eligible for a spousal benefit, which is half of Tom's benefit. Since her spousal benefit will be $1,250 a month, Social Security will provide her with a higher amount, which is $1,250. To qualify for spousal benefits, several conditions must be met. You must be 62 or older, you need to have been married for at least 1 year, and finally, your spouse must have already filed for their benefits. It's often easier to understand this with a visual, so let's break it down. Let's say Tom and Mary are in the same situation, but this time, Tom waits until 70 to file so that his benefit grows by 8% a year, increasing from $2,500 to $3,300 a month. When Mary turns 66, she files and Social Security checks if she's eligible for spousal benefits. Since Tom hasn't filed yet, Mary can only claim the $1,200 based on her earnings. When Tom files a year later at age 70, Mary's benefit will increase to $1,250. But notice I didn't say she would receive half of Tom's increased benefit of $3,300. Instead, it's still based on his original $2,500 benefit. Waiting until age 70 helps them by increasing his benefit and the household's overall income, but it doesn't increase Mary's spousal benefit. One key point is that when either Tom or Mary passes away, the survivor benefit will be based on Tom's increased benefit. So Mary will receive $3,300 if she outlives Tom. More on that later. Now, let's explore what happens if Tom files early. If Tom files at 62, his monthly benefit drops from $2,500 to $1,800. If Mary waits until 66, she's still eligible for $1,250, which is half of Tom's full retirement age benefit, even though Tom filed early. This is because Social Security considers Mary's age at filing, not Tom's. So what if Mary files early? Let's say Tom files at 66 and Mary files at 63. Social Security will look at the $1,200 Mary would have received at full retirement age and the $1,250 spousal benefit. Since the spousal benefit is higher, they will reduce the $1,250 by roughly 18% to $1,025 because she's filing 3 years early. Now this reduction is permanent. Her benefit won't increase once she reaches full retirement age. Now that we've covered spousal benefits, let's discuss the rules for divorced individuals. Divorced benefits, or ex-spousal benefits, are very similar to spousal benefits except for a few key rules. As a divorced spouse, you may be entitled to Social Security benefits based on your ex's work record if you were married for at least 10 years, you are unmarried at the time of filing, and you and your ex-spouse are both age 62 and older. Notice that this last rule differs from the spousal benefits we discussed earlier. With spousal benefits, you only qualify once your spouse has filed. With ex-spousal benefits, Social Security does not require the ex-spouse to file. Instead, it restricts filing based on age. This is because many individuals would have difficulty tracking whether their ex-spouse has already filed. Assuming you meet these three rules, ex-spousal benefits work the same as spousal benefits. The ex-spousal benefit is still calculated as half of your ex-spouse's full retirement age benefit, assuming you wait to file for benefits until you reach full retirement age. If you file for an ex-spousal benefit before full retirement age, it will be permanently reduced and you will be subject to the Social Security earnings limits. On the other hand, If you wait past your full retirement age to claim your ex-spousal benefit, it will not increase. So there is no reason to wait beyond your full retirement age to apply for an ex-spousal benefit. You will only be allowed to collect your benefit or your ex-spousal benefit, whichever is higher. You cannot receive a benefit from both your work record and simultaneously receive a benefit from your ex-spouse's record. Now, let's shift our focus to survivor benefits. An individual may be eligible for a survivor benefit when their current spouse dies, or if divorced, when their ex-spouse dies. An individual cannot receive both their benefit and a survivor benefit, so it makes sense for someone to file for survivor benefits only if the survivor benefit is higher than their own, or if they want to collect their survivor benefits while waiting for their benefit to continue growing. So how is the survivor benefit calculated? The survivor benefit you receive depends on the amount your spouse received or would have received at the time of their death. If they had already filed for Social Security, you will receive whatever amount they were getting. If they were waiting to file and passed away before reaching full retirement age, you would typically receive a benefit close to their estimated full retirement age benefit. If they were waiting to file for benefits until age 70 but died at age 68, the survivor benefit will be increased to reflect the 2 years of waiting. For instance, if the deceased spouse's full retirement age benefit was $2,500, the survivor benefits at age 68 would be $2,900 due to the 16% increase. Now that we've discussed calculating the survivor benefit, let's determine when you can begin receiving it. You can start taking survivor benefits as early as age 60, but the benefits will be reduced. Just like with other Social Security benefits, if you earn more than the $23,400 limit annually, your benefits may be further reduced. If you are still working and earning above the limit, you may not qualify for a survivor benefit until your earnings decrease or you reach full retirement age. This is a common issue for people who try to claim survivor benefits while still working. By waiting until your full retirement age to file for survivor benefits, you will receive the whole survivor benefit with no reductions. The survivor benefit does not grow beyond your full retirement age, so it does not make sense to wait past this time. A nice feature with survivor benefits that's not available with other retirement benefits is the ability to switch from your work record benefit to a survivor benefit or vice versa. For instance, you can take a reduced survivor benefit at age 60 and switch to your delayed retirement benefit at age 70. Alternatively, you can file for your reduced benefit at age 62 and then switch to your whole survivor benefit at full retirement age. This flexibility allows you to maximize your Social Security income. So let's consider how survivor benefits could affect our filing strategy when married. If you are the higher earner in the household, delaying your Social Security benefits until age 70 can be a wise strategy. This not only increases your benefit during your lifetime, but also ensures that your surviving spouse will receive a higher survivor benefit if you pass away first. So let's discuss public pensions and how they may affect your Social Security benefits. As of January 5th, 2025, Social Security benefits are no longer reduced due to a public pension. These former programs were called the Windfall Elimination Provision and the Government Pension Offset. The law was made retroactive to January 2024. Contact Social Security if your benefit was being reduced, or if you never filed for Social Security benefits due to your public pension, as you may be entitled to an increase. Let's discuss retroactive benefits and the withdrawal of benefits. If you wait beyond your full retirement age to file for benefits, the Social Security Administration will ask you if you want to backdate your application up to 6 months and receive a lump sum payment. This is known as retroactive benefits. By doing so, you lower your monthly income as if you had filed 6 months earlier. For instance, if your full retirement age benefit is $2,500 and your benefit would have been $2,400 6 months earlier, Social Security will ask if you would like to accept the lower monthly amount of $2,400 while also receiving a lump sum benefit of $14,400, which is 6 times the reduced amount. While most individuals do decline this option because the whole reason they were waiting was to increase the benefit, this option is beneficial if something has changed, such as a job loss, death of a spouse, or medical diagnosis. Please note, the retroactive benefit option is not available when filing before full retirement age. The other filing option available is called a withdrawal of benefits. Social Security allows individuals to withdraw their application up to 12 months after filing. To do so, an individual must pay back the gross amount they received from the time of filing to the time they withdrew the application. For example, if I filed in April of this year and received 4 benefit payments of $2,500, I would need to file Form SSA-521 and pay back $10,000. The most common scenario in which we see this is when an individual is unemployed when they file for Social Security benefits, and then, within 12 months, secure a job. So they no longer need their Social Security benefits and want to allow them to continue to grow. You are limited to 1 withdrawal of benefits during your lifetime. Now, how does the cost of living adjustment work? The Social Security system provides a cost of living adjustment annually to all retirees. This adjustment is calculated using the annual change in CPIW, the Consumer Price Index for urban wage earners and clerical workers. As you can see from the graph, the COLA can range significantly. In 2009 and 2010, it was 0%, whereas in 2023, it was 8.7%. Each October, retirees are sent a letter or email notification with the new cost of living adjustment for the upcoming year. There is nothing an individual needs to do, as the adjustment is applied automatically. This cost of living adjustment also applies to individuals age 62 or above who have not yet filed. This prevents individuals waiting to take their benefits from missing out on these upward adjustments. So what do I need to know about the earnings limit? An earnings limit applies when filing for any Social Security retirement benefits before full retirement age, including your benefit, spousal benefit, ex-spousal benefit, and survivor benefits. In 2025, the earnings limit is $23,400. For every $2 of earnings above this limit, Social Security will reduce your benefits by $1. Income such as pensions, IRA withdrawals, annuity withdrawals, capital gains, interest and dividends, and other passive income is not considered towards the earnings limit. Only earned income such as W-2 income, 1099 income, and K-1 income are considered. Let's look at an example. Assume I have earned an income of $60,000 and a monthly Social Security benefit of $1,500. Because I am over the earned income limit, my benefits will be reduced. To simplify the numbers, I will round the earnings limit to $23,000 and say I'm $37,000 over the limit. Social Security will reduce my annual benefits by $18,500, which is half of the $37,000. Given that my initial monthly benefit was only $1,500 or $18,000 annually, and my reduction is $18,500, I will not receive any Social Security benefits this year. For this reason, most individuals choose not to file early if their earnings are significantly more than the earnings limit. The good news is that once you reach full retirement age, there's no longer an earnings limit, so you're free to make as much as you want while also collecting your entire Social Security benefit. Now I want to discuss one additional scenario briefly. There is a special earnings limit in the calendar year you file for Social Security benefits. You can see it in the middle column, which shows $62,160. Your full retirement age determines the amount you can earn. If my full retirement age is in September, I can make $41,440 between January and August before they reduce my Social Security benefits. If a reduction is necessary, it is a 3-to-1 reduction instead of the previously discussed 2-to-1 reduction. So how are my Social Security benefits taxed? The answer depends on what other income you will receive throughout the year. The IRS provides a worksheet to determine if your Social Security benefits are taxable, which you can find in IRS Publication 915, Worksheet 1. If you're calculating this on your own, that's the official resource to reference. Social Security uses a term called provisional income to determine taxation. It's calculated by taking half of your annual Social Security benefits plus your adjusted gross income, plus any municipal bond income. The worksheet can be tedious, so I'm providing a simplified process for approximating the taxes due. Step 1. Determine the amount of Social Security benefits you will receive this year before deductions or taxes are removed. If you are married, this includes your spouse's Social Security benefits. You will then cut this amount in half for the calculation. Step 2. Estimate your taxable income, which will include all income other than Roth IRA withdrawals. This includes items such as wages, salaries, tips, interest earned, including municipal bond interest, dividends, capital gains, IRA distributions, pension income, annuity income, and other income listed on IRS Form 1040, Schedule 1, Line 9, such as alimony received, business income, rental real estate income, and unemployment compensation. Step 3. Add half your Social Security income from Step 1 to the income in Step 2. This is your provisional income. Step 4. Compare your provisional income to the following chart. As you can see, if you are married and filing jointly and your provisional income is over $44,000, up to 85% of your Social Security benefits may be taxable. If you are under $32,000, your Social Security benefits are not federally taxed. Let's look at a case study to help clarify how this works. Both couples need $67,000 a year for living expenses. The only difference between the two couples is that couple 1 is taking $25,000 from a traditional IRA, and couple 2 is taking $25,000 from a Roth IRA instead. This relatively simple adjustment creates a significant difference in how their Social Security benefits will be taxed. The provisional income for couple 1 will be $56,000, and for couple 2, $31,000, since the Roth IRA withdrawals are not included. Now, if we assume a 12% federal tax bracket, this difference will save couple 1 $2,244 in federal taxes every year. Now, how do I determine if I will owe state income tax on my Social Security benefits? Many states, including Illinois, where we are based, do not tax Social Security benefits. However, 9 states currently do, and each one has its own rules and tax calculations. If you live in one of these states, it's best to check your state's Department of Revenue website for the most up-to-date details. Here's a list of the 9 states that tax Social Security benefits in alphabetical order: Colorado, Connecticut, Kansas, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. If your Social Security benefits are currently tax-free, be mindful of financial decisions that could increase your provisional income, such as Roth conversions, selling investments with capital gains, or taking additional IRA withdrawals. These actions could push your income above the threshold, making a portion of your Social Security benefits taxable, and potentially leading to an unexpected tax bill. If you found this information helpful, please give us a thumbs up and subscribe for more financial insights. Thanks for watching, and we'll see you next time. Once again, I'm Mike Heatwall, founder and CEO of the Dalla Group. If you are interested in seeing how we help our clients, visit us at www.thedallagroup.com. Give us a call or schedule a time to connect with one of our wealth advisors. We would love to hear from you.